Young landlords have benefited from red-hot rental markets across the country, and until the last year, low costs on mortgages. But now many are struggling to cover higher borrowing costs and are rethinking their investment.
People get into the sector, decide they don't like being landlords, and they get out. Or they overestimate the return they're going to make on the property or underestimate the expenses.
Royal LePage's new snapshot of real estate investment paints a picture of those invested. 1 in 10, or about 4.4 million, currently own an investment property, according to an online poll. A third own 2 or more properties, and multiple property owners are more likely to be aged 34 and under than older than 35.
The stock market has been a tough place, a lot of negative returns. And so people are looking at the real estate market and saying, that might be a better place for my investment.
But more than 30% of investment property owners are considering selling because of higher lending rates, especially those in Toronto, Vancouver, and Montreal. New data from the Canada Mortgage and Housing Corporation shows residential mortgage debt hit a record $2.08 trillion in January. That is up 6% in a year. And there's news this week that Canadian household debt has eclipsed GDP and is the highest among G7 countries. This housing finance research expert says there's an uptick in mortgages in arrears.
That does remain a potential vulnerability for our financial system. In our report, we're already seeing some early signs that some mortgage consumers may be under financial strain.
Those looking to unload investment property need to consider the business case.
Definitely speak with an accountant to really understand, how much is it going to cost you to sell and offload that property, not just in taxes, but what you're going to get after paying closing costs and whatnot.
Anne Gaviola, Global News, Toronto.